In this video, we're going to talk about the way in which companies should account for financial instruments. However, we will be looking at financial instruments which appear as assets in the balance sheet. So these will, for example, be purchased bonds, bonds held as investments, or stocks held, equity instruments held as investments. Not the financial instruments that get issued, which will sit on the other side of the balance sheet in the case of equity, issued equity, obviously under equity. In the case of issued bonds, that would be under liabilities. Please bear in mind that derivatives are quite tricky because derivatives are typically reported at fair value, and as you should know from the derivatives section of the curriculum, many of them are of a linear nature, symmetrical nature, so sometimes their value, the value of the position is positive, but at other times it may be negative, and depending on which it is, derivatives may either appear as assets if they've got a positive value for the position holder, or liabilities if that value is negative. Now, we're going to talk simply about those financial instruments that appear as assets, so purchased bonds and purchased shares. However, our focus, this is also the focus of the book in this section, will be on bonds, on purchased bonds. In reality, this is one of the most complicated topics in accounting, kind of the whole of accounting, how to properly account for financial instruments, and the rules, the technical rules, are extremely complicated, complex, and we're going to, obviously we can't cover everything. Your book is quite selective in what it covers, so I'll try to help you understand what the different terms mean and how the accounting is done. So when we perform what's known as measurement, that is, determining the carrying value, the carrying amount of an asset. In the case of assets that are financial instruments, there are essentially two ways you can go, or indeed three ways you can go. You can either measure the carrying amount at what is known as amortised cost, or cost. Now, this cost bit really applies more to equity securities. Amortised cost is the one we apply to debt. Okay, so cost would be relevant to equities, which are sometimes indeed reported at cost. And the second, let's say, approach, or the alternative, is to report at fair value, where fair value is a complicated topic in itself, but at least for the purposes of this video, think about fair value as the market value, the market price. That's not always going to be available, but we don't have to worry about this. Now, fair value, this approach has, let's say, two more specific strands, because ultimately, when you measure something at fair value, that fair value is subject to fluctuations. You have two options with regard to where you will show changes in that fair value. Changes in either V, so fair value, I'm going to abbreviate often to a V, are where they are shown or where they go through. Changes in fair value reported through, you'll see what that means because I'll show you examples, numerical examples of how this works. Either OCI, which stands for Other Comprehensive Income. If you haven't really encountered other comprehensive income until now, you will in this video. It's important to understand and appreciate what that means. And the other alternative is to have those fair value changes reported in P&L, which means profit and loss, or the income statement. Right. From now on, most of the stuff will be numerical, but this is a good thing to sort of jot down. If you're relatively new to this topic, it will help you hopefully appreciate what's going on. So I'm going to base my example on a debt security, a really simple one. Let's assume that we as a company or a financial institution, whatever, we don't produce, we purchase a, let's say, 3-year, to make it simple, 0 coupon bond whose face value, obviously to be received at the end of those 3 years, is a nice round €1,000. And right now, that bond is trading in the market at a heavily discounted value of €751. Now, I've made it really low because I want this example to be easy. And the great thing about this is if you take your Texas Instruments calculator and you, based on this data, the 3-year term to maturity, the fact that it's a zero coupon instrument, it's got a face value, future value of 1,000, and it's got a price that you have to pay at the beginning of 751. That should get us to compute a rather nice round yield to maturity, and you need to compute the yield to maturity when you try to account for debt securities. It's essential, right? I don't think they'll get you to do this in the exam, but for the purposes of following this example, you need to appreciate what's going on. Once this section, I don't think they'll ask you for anything numerical, but by solving this example with me or watching it, you'll fully appreciate what the three different approaches are. That's measurement at amortized cost, at fair value via OCI, and via P&L, which are, the two ones in blue are distinct approaches. Right, so let's power up the time value of money worksheet. Let's clear it first. So second followed by ever V, which you should know from other topics. And let's make the inputs 3 for N, 0 for PMT. After all, this is a zero coupon bond. 1,000 is going to be my ever V input. And I'm going to make 751 negative because that's the cash flow we suffer at the beginning, my PV input. And I'll get the calculator to compute I over Y, which is YTM, yield to maturity. As you can see, it looks like a very nice 10% or very close to it. Now, in the fixed income section of the curriculum, we call this the yield to maturity. In accounting, we typically refer to this as the effective rate of interest, but the effective rate of interest is basically saying yield to maturity. Don't bother learning this term, but you may encounter it when you read financial statements. Right, let's also now assume that although we've got the price, the market price at the very outset when the instrument is purchased, that market price will evolve over time. So at time 0, that's the date of purchase, it is indeed 751, but let's introduce and speculate about what can happen subsequently. Maybe after 1 year, it would be worth 835 in the market, right? At the end of year 2, 890, and of course, by the end of year 3, it should be equal to 1,000, which is what you're going to, in just a moment's time, receive from the issuer. Now, let me present to you, with this example, this is all the data we need. We will now go via or through the 3 approaches, starting on the left with measurement at amortized cost, followed by fair value via OCI or through OCI, and fair value through P&L, to show how this chain of events, the purchase of the bond followed by its subsequent holding, would get reported. I'm going to assume that we hold the bond until the very end, until the end of year 3, although that's not necessarily always going to be the case. So we're going to start off with measurement at amortized cost. Okay, and before I do any computations with you and do the actual example with you, let me just note, I'll write things down later on, but this is typically the approach that we use when we intend to hold the instrument. Really, we know that we intend to hold it to maturity. I'll write down some rules in just a moment, but for now, let's go to a template of the financial statements. Over here, I'm going to simply write that this is going to be the amortized cost approach. Okay, and Right, what happens initially? Well, initially, out of our assets, we experience a cash outflow. The bond was supposed to have been purchased for 751. It's an asset, it's an investment that we make. So, you know, let's say we've got some debt securities over here as an asset. How you would call this is not really that important. Companies often call this, you know, financial assets, measured at amortized cost or something like this. I'm just going to say debt securities. Now, this is the initial purchase, right? So the moment when we make the acquisition, when we buy. When you measure at amortized cost, the fact that the debt security subsequently changes its value in a, you know, pretty unpredictable way, in the sense of going up by, or sometimes going down, actually not in this example, it continues going up in some way as dictated by demand and supply conditions, doesn't really interest you, because you set out a predetermined path for going from the initial 751, which you enter into your financial statements at time zero, all the way to that, you know, predicted 1,000 at the end of year 3. And it's not a linear path, but it's a path that if you already studied fixed income, you would know as the constant price yield trajectory. So something that would more or less look like this. What we will do is every one of those 3 years when the bond is held, so over here I'm making columns for year 1, year 2, and year 3, we would increase the value, the carrying amount, the value at which the asset is measured by 10%. Why 10%? Because 10% is that asset's yield to maturity, that's why we computed it, or the effective rate of interest. In accounting, when you follow the measurement at amortized cost approach, you apply the effective rate of interest, which is the instrument's original yield to maturity. So let's have a look at what this would cause. Well, if you apply 10% to 751, you get growth of more or less 75. I'm going to, of course, apply rounding here. So this is growth of 75. And, you know, if you begun with 751 and then add 75, let me just check this on the calculator, 751 plus 75, that gives, okay, a value of 826. This would be the asset's amortized cost at the end of year 1. It's absolutely not the same as that asset's end of year 1 market price. The market price is different, 833. But the thing is, we don't care. We report the asset at 826 because our job here isn't to show the fair value of the asset. That's what happens under the other approaches. So even though the fair value may be, you know, completely different, 835, I don't care. I report 826, which is the amortized cost computed using the original YTM, yield to maturity or effective interest rate. Now, even though this asset is indeed a zero coupon bond, so one that doesn't generate any current income, any current interest, what happens paradoxically for many people is that on the income statement, you know, your book contains an example of this, but doesn't feature as many sort of explanations or computations, just tells you where things get reported, is that in the income statement of the holder of this bond, you report interest income. After all, you hold bonds primarily to make money from the passage of time and, you know, the element of credit risk, and we call that interest. So in year 1, because the asset grows in value by 75, you will report plus 75 of interest income, which will impact your income statement. It will impact your P&L. This is the P&L, another name for it. And as you will appreciate, everything that goes to the income statement, to the P&L, will also have an impact on retained earnings within equity. So let me introduce this, retained earnings over here. These also, year 1, year 2, year 3, these also go up by 75. And as you can see, hopefully, because the asset went up by 75, not because we received something, not because its real market value went up by 75, no, just because we applied a sort of very abstract computation here. Both the asset and equity section of the balance sheet go up by the same amount, and our balance sheet stays in a sort of condition of balancing, right, if we increase both sides by the same amount. Now, we will do exactly the same thing next year as well. So in the next year, we take the amortized cost or the carrying value from the previous year, and we also raise it by 10%. So once again, I'm doing a bit of rounding. So this would give us, I guess, more or less, well, it's 82.6. So I'm going to make this 83. So you can see that the growth increases. And once again, that growth is called interest income, and it is reported in P&L. And if it's reported in P&L as something positive, it will also have a positive impact on our equity. So 83, 83. Now, the value of the asset in the balance sheet, it was 826. If we now add an additional 83 to it, we get to a level of 909. And that, once again, is your amortized cost, or the amortized cost of the asset. Once again, it is probably completely different from the market price of the asset as measured at the end of year 2, but we don't care. Because the reason why we don't care is we don't intend to sell this asset in the market, so why should we bother with this 890? We intend to essentially hold it until maturity. So we've got a pre-programmed, let's say, path of getting to that ultimate 1,000 face value. And this is indeed what will happen if in the third year we once again apply 10% to what we already had in the balance sheet, the previous period's end of period amortized cost or carrying value, which gives growth of 91. 909 plus 91, don't need a calculator for that, gets us to 1,000. And in just a moment's time, somebody should pay you 1,000. You should get 1,000 from the issuer. Cash goes up, and then the value of the asset goes down because the asset gets recognized once you get the payment. You no longer have any rights associated with it. And of course, that final 91 increase over here will also go to P&L and will have a positive impact on equity. And if you measure everything that is reported in P&L over that period of 3 years, we have 75 plus 83 plus 91. It gives a total of 249, which is essentially the distance from the initial price 751 to the face value 249. Now that trajectory which I drew here isn't really right. In terms of being the wrong shape, it should be like this, right? So the growth in the initial years is, let's say, 75, but then becomes a bit bigger in the final year. It's, it's the steepest, right? This is amortized cost. Companies like using this approach because it gives them predictability over, what they will be showing in their income statement. You know exactly what will happen in your income statement, which is important because you know what profit you'll be able to report. So when is this approach going to be applicable? Well, US GAAP says that you should use this for debt securities, for debt instruments which are held to maturity, which you indeed intend to hold to maturity, right? IFRS used to call this held to maturity. For example, when I was working in banking, we would call this portfolio the held to maturity portfolio. But these days, IFRS has changed a bit, and they talk about this in a more sort of roundabout way. They say this approach should be used, obviously not in these very same words, should be used or should be applied if the business model of the company with regard to these specific securities is to, yes, hold the asset to maturity. At least this is what your book says. I'm not sure if IFRS really uses this term. But, you know, if the cash flows from the asset are all about collecting principal and interest, which is going to be the case with most debt instruments, and you intend to hold the asset and just collect the principal and interest on scheduled dates. I mean, in order to use this approach, you need to calculate what in accounting is known as the effective rate of interest, or in the world of fixed income is known as the yield to maturity. If you can't calculate this, you can't really calculate that, you know, do that price trajectory, that constant yield price trajectory. And so you need scheduled dates on which payments are made, repayments are made, payments of interest and payments of principal. Now, let me just say, because I did write over here /costs, or amortized cost /cost, it is possible to apply a variant of this. It's just going to be called the cost model. So you record an asset in your balance sheet at its initial cost, and you just keep this cost. You do nothing to it. It stays completely flat. When would you do this? You would do this for unquoted equities. So shares. Now, normally shares are supposed to be reported at measured at fair value under accounting rules. But if you've got a share in your portfolio which is unlisted, so let's say it's a private equity investment, and you claim, or you can prove to your auditor that it would be impossible to reliably measure the fair value of that instrument, you are then able to report it at cost. So this is for unquoted equities for which, for which fair value cannot be established reliably. Now, your book here makes a lot of shortcuts, right? In reality, there are many sort of limitations on the application of this, cannot be established reliably, but this is generally the gist of it, or the hint, or the idea. If you hold shares, if you've bought shares, they're not listed on a market, so you can't track their market price. And it would be very unreliable to compute their fair value using, you know, a model like the dividend discount model, maybe because, you know, the asset doesn't generate predictable dividends. Yeah, many such cases in the when we talk about startups, venture capital, for example. Just keep the asset in your balance sheet at initial cost. Don't try to do any measurement to fair value. It would be, if you think it would be unreliable. Now, the second approach we're going to jump to is fair value, but with changes in fair value reported through OCI, via OCI. I'm, of course, going to use the same example, the same bond, and I'm not going to tell you when this approach is going to be used yet. I'll first just discuss its application with numbers. So, yeah, here we go. Let's title this Fair Value. via other comprehensive income, OCI. Now the initial point at time zero is, or the initial entries are the same. So you spend cash, 751 out, and you get yourself, you load your assets up with debt securities. Yeah. Now this is going to be a common theme for all the approaches. You always kind of record financial assets typically at their cost of purchase, so their initial value. But then you're going to have these, 3 years worth of entries everywhere pretty much. Okay, so let me just leave this like so, and we're going to do stuff to equity as well. So let me leave some space here. This is arguably this is the most sort of difficult of all the approaches for people to understand conceptually, because it kind of goes against most people's thinking. Even seasoned accountants who don't typically deal with financial securities, financial instruments accounting, have a problem with this, so don't worry, it is objectively complicated. Now, this time around, I'm not going to, let's say, report the asset at some hypothetical amortized cost which exists in my Excel only, or on paper only. I'm going to really have to track what's happening to the fair value. That's the market price of the asset. So yes, it does begin at 751, but subsequently rises to 835, 890, and of course the ultimate 1000, which we reached under the other approach as well. So in the first year, there is an increase to 835 in terms of the value of the asset. I mean, we begin at 751, so as to get to 835, that is growth of 84. Okay, so the asset grows by 84. This carrying amount is the fair value. Good. However, some of you will know that kind of beneath the P&L, there is a segment called OCI, Other Comprehensive Income, which is supposed to hold various gains or losses that impact a company's equity but do not get reported within P&L. Not all gains and losses go to P&L as such. We're going to utilize this segment, but it would be wrong to think that the whole change in the value of the asset from its initial 751 to the current 835, that whole 84 goes to OCI. Absolutely not. And your book does make this comment as well and shows it as well. You would still, in your income statement, have interest income being reported. And this interest income would be reported and computed in exactly the same way as before. So using the yield to maturity, the effective interest rate, as applied to that constant price yield trajectory value. So even though you're now doing a different measurement approach, measurement at fair value, you still have to kind of track what the values would be under the most basic of approaches, which is amortized cost. So in year one, we would still report 75 of interest income, just like under the other approach. And this would, because it goes via P&L, it would impact our company's retained earnings. Everything that passes through P&L impacts equity via retained earnings. But of course, this 75 alone is not enough to match what happened on the side of the asset growth. And this is where OCI comes in. OCI is supposed to capture the difference. This is known as the unrealized fair value gain or loss. I mean, there are different ways to call this, unrealized or just fair value gains and losses. And it's just there to capture the difference. So if you've already taken 75 of interest income, and I appreciate that this may be extremely abstract to you because, after all, we are talking about a zero coupon instrument, aren't we, which doesn't generate a current coupon. but we still compute interest income from the so-called unwinding of the discount on it using that constant YTM, yield to maturity. Any difference that you need to get yourself up to 84, which in this case would be a positive 9, wouldn't it, would go to OCI. And now the total of what goes to P&L and OCI, so total comprehensive income, is indeed 84. Now, what passes via OCI is not transferred to retained earnings. You can't pay a dividend out of it. It goes to some special line within equity, like, you know, different companies call this different names, but it could be accumulated, you know, gains or losses, OCI gains or losses, something like this. And here we will have a positive 9. So your equity gets impacted by both the 75 and the 9. So the total impact on equity is 1 of 84, the same as the growth in the asset. But there is this somewhat artificial split into what would be called interest income and OCI gains or losses. In the second year, well, actually, before I go to the second year, let me show you an example of this happening in an actual set of financial statements. What I've done is I've opened up the financial statements of a very large financial institution, Deutsche Bank, right? So this is Deutsche Bank's balance sheet as at December 31st, 2024, and the end of the previous year as well. And within financial assets, you will see that some of them are called financial assets at fair value through other comprehensive income, right? That's what we've got. There are also assets at amortised cost. By the way, loans, especially when loans are held by banks, actually loans of any types, are typically measured at amortised cost. Yeah? But we have some financial assets at fair value through other comprehensive income, so through OCI. And when we go to this bank's statement of changes in equity, you will see that one of the reasons for changes in equity to happen are unrealized gains or losses, we see this at the top, on assets at fair value through other comprehensive income. So you see that this contributes to changes in equity. And in fact, you know, going up a little bit, when you see the consolidated statement of income, which finishes with some profit or loss, on the next page we have consolidated statement of comprehensive income, and you do have other comprehensive income being shown, so OCI, and one of the inputs into the OCI computation is what happens to the unrealized net gains or losses arising during the period, and this is on basically on instruments that are measured via OCI. Right, so I just wanted to give you a real life perspective. In reality, it's very difficult to read this stuff because there's lots happening there. My example is nice and simple. You don't have reclassifications, you don't have movements in and out of OCI, but in reality, it becomes a bit more complex. Good. So what happens in the next year? Well, in the next year, that asset's fair value is supposed to increase to 890. So going or focusing on assets, we've got to do what's needed to take the carrying amount of the asset to that amount, you know, whatever is the fair value. We were already at 835. Now, to get us up to 890, I don't really need to take my calculator out for this. I can tell this is growth of 55. You can be absolutely sure that this growth in the asset of 55 is also going to be matched by the growth in equity, because these two are going to be the same after all. However, what will pass via the P&L and what will pass, via the OCI, other comprehensive income, is a different story. Interest income as going to the income statement or the P&L is whatever you would show under the amortized cost approach, which is that that 83 which we already computed on the amortized cost. So this is the same as before, 83. But 83 is, which we take to retained earnings as well, and we can use that to pay dividends to shareholders. 83 is too much compared to the 55 that we need our equity to go up by. So this time around, our OCI has to absorb the difference, but it's going to be a negative difference. We need to go from 83 down to 55, which, well, let's see, 83 minus 55 is a net difference of minus 28. Okay, this is what we will take to OCI. So the total taken to P&L and OCI, so-called total comprehensive income, is still 55, right? Let me actually write this here. Total comprehensive income is the total, is the sum of everything that went to P&L and OCI. So in this period, it's 55. In the previous one, it was actually a positive 84. However, this minus 28 impacts our accumulated gains or losses. And over here, if you saw this amount being reported, it would have a balance of plus 9 in 1 year, and in the second year, it would be plus 9 minus 28. Let's see, 9 minus 28, that gives minus 19. And you see, what this minus 19 represents is the difference between the fair value of the asset at a specific point in time, the fact that it's only trading at 890, whereas if it kept going up according to the constant price yield trajectory, it should already be at a value of 909. So 909 is where it kind of should be if it continued evolving under the YTM assumption being constant, but it's currently at 890, and this is a difference of negative 19, and that's what our accumulated unrealized gains losses show. In the final period, we have to go all the way to 1,000, right? The asset increases in value to its ultimate 1,000, so that is, no need to take the calculator out, growth of 110. And once again, we're going to experience that 110 growth over here within equity. However, taking some of it to P&L and taking some of it to OCI. The amount of interest we're going to report is the same 91 as before. So let me enter this over here, plus 91, going to P&L, and of course going to retained earnings as well. In order to get all the way up to 110, we need an additional 19, and that 19 passes through OCI. It's positive, so as to give a total comprehensive income of 110. And of course, it passes through this accumulated gains or losses line, and because its previous carrying amount was of the accumulated, gains or losses, unrealized gains or losses, was minus 19, now introducing a positive 19 here resets this down to 0. So as you can see, if you do indeed end up holding the asset to maturity, that line clears itself up, but it records all the temporary differences between where the price of the asset actually is relative to where that constant price yield trajectory would predict that it should be if interest rates were kept constant. Obviously, interest rates are not kept constant. If you've already studied the relevant sections of fixed income, you'll find this much easier. That point about there being a constant yield price trajectory, which we utilize here, but we call it amortized cost. Right. Let's put down a couple of notes on this approach, especially when it will be applicable. So this is fair value through so-called through OCI, other comprehensive income. Well, US GAAP says this should be used for available for sale debt securities. Now, available for sale debt securities are instruments of a debt nature, of course, which you currently hold, but you can't really commit to holding them all the way until to maturity. You might decide to sell them. You're not holding them for quick gains, so that they're not sort of part of your trading portfolio, but you're unable to commit to hold them to maturity. This is when you would apply this approach. In the balance sheet, you're forced to constantly show the present, the present fair value, the current fair value, but at least your P&L is, let's say, protected from showing the full extent of the fluctuations. Your P&L functions in a sort of pre-programmed way, just like with amortized cost. And please appreciate that, especially if you're a financial institution, you want to, or like a big bank, for example, being able to predict and forecast how your P&L will look is going to be very valuable. And the more you can protect your P&L from suffering these potential sort of shocks, sometimes up, sometimes down, is good. This is absolutely something valuable. Now, IFRS kind of says the same thing, but in a different way. It says this is meant for debt securities for which the business model, IFRS is big on describing business model, the business model of the company. So why are you holding this stuff? Well, if you're holding it for the purpose of collecting interest payments, principal payments, but also are, open to the idea of selling the asset, this is going to be the right approach for you. Please notice how different this is from the previous business model, so to speak, where we said, well, the purpose should be to collect principal and interest on scheduled days. Here, collect interest and principal, yes, on scheduled days, of course, but also potentially selling the asset before its maturity date. Let me also say that it is possible to choose this approach for equities, under IFRS at least. So you can have equities sitting in your balance sheet and being measured at fair value, but all the changes in fair value will then be reported in OCI relative to their initial cost of purchase. Your book doesn't explore such an example, so don't worry about it. I think when you get to level 2, you'll have to know a bit more about this. Now, the final approach, and I think this will now be easy because we've covered a lot of ground, would be fair value, but through P&L, profit and loss. And this is the most extreme of the approaches, but we've got all the values already in place from previous computations. So things begin in exactly the same way as before. You spend the cash, 751, and you get yourself a debt security being reported on the balance sheet, 751. Okay, and then let's make columns for the individual periods, 1, 2, 3, 1, 2, and the residual 3. I'm not going to utilize the OCI segment in this one, right? But of course, I'll need to record stuff within equity, so 1, 2, and third year. This approach also relies on tracking the fair value of the asset. So, we begin at 751 and subsequently need to show increases to 835, 890, and 1,000. Okay. 835, 890, and 1,000. So what's in the balance sheet is always the fair value from the market. In the first year, just like before, this means recording growth of 84. And look, this growth of 84, which the asset experiences, will also be experienced within equity. But this time, all of that growth will pass through the income statement. All of that change will go to P&L. However, it will still be split into its relevant components. So we would have interest income, just like before, right, being recorded at 75. So this computation, which is based on the original yield to maturity, the effective interest rate, and this amortized cost concept, is going to drag with us through all the approaches. And it's just that this time the unrealized gain or loss component, that +9, which previously would have been taken to a segment called OCI so as to not distort the income statement and the profit of the company as reported in P&L. This time it also goes over here. So the whole 84 passes through P&L, through the income statement, and therefore gets taken to retained earnings. Yeah, plus 84. Impacting our ability to pay a dividend out of. In the next year, we experience much smaller growth. We already computed this. It was 55. But once again, that entire 55 is taken to equity 55. But of course, this time going through the P&L. But it gets split, just like a moment ago, into the interest income and unrealized gain loss bit. So the interest income would be 83. What went to OCI was 28 negative. So here we would report positive 83, and this would be negative 28. So this time, as you can see, your P&L is pretty badly affected. You only report 55 in your P&L, as opposed to if you were able to apply the previous approach, where the unrealized gains losses go through OCI, your P&L would have 83 positive in it. This time it's just 55. All of that gets taken to equity. Right, and the final year's growth was 110. So yeah, once again, this goes to equity 110. Everything will go via the income statement, but like before, split into the interest income, 91, and the residual figure. So 91 here, plus 19 here. All of these unrealized gains losses, ultimately, they zero out, right? The net amount zeroes out. What gets reported via interest income is a total of 249, which is common across all of these approaches. In interest income, we report 249. This is what we also started with when we did the first example with amortized cost. It's just the question of whether you at all measure the other bits, those other gains or losses, to fair value, and if you do you report them in OCI or P&L. Let's just conclude the example here. Yeah, we had 110 going to P&L in total, so growth of 110 over here as well. Let's go back to the note and say that this approach, so fair value through P&L, through the profit and loss account is, first of all, it's the default category for equities. So most equities, especially if they are listed, should be reported in this way. Although it is possible to designate some equities into the via OCI category, and if the equity instruments are unquoted and you can't really reliably measure their fair value, you are able to sort of measure them at cost, although at least under IFRS that should be an exception. And in the case of debt securities, it should be applied to primarily trading instruments. So instruments you hold for short periods of time to just profit from the price change, as opposed to holding them for the motive of collecting coupons and interest and principal.